Y'all planning for this?
Well, welcome back to a What Works Wednesday. No, this is not Matthew Jarvis, the normal host, but don't you fret because I have another Jarvis on the line with me. So this is Micah Shalansky, the co-host of The Perfect RA, with Steven Jarvis, the CPA. Hey, Steven, how's it going?
Hey, Micah, I'm so excited to be here with you.
Yeah, super excited. Sorry, I would not used to these What Works Wednesdays, but I'm super excited. We're in person, actually jamming out some great content.
Heck yeah.
And one of the things that had come through a little while ago was some questions, and we were ripping through some content with some other advisors, and it got into some things on some Schedule Cs that had come up. And then when you and I were talking about it, there was a lot of like deer in the headlights looks from these advisors, which is fair, right? There's a lot of stuff that I don't know about financial planning still, and I'm looking to learn. But this is something I thought it would be great to kind of jam out a little bit more. Really want to pick your brain because you are the expert on the CPA on this side of it, and get some good knowledge dump on getting into details of planning and planning with small businesses and especially some LLCs and some things to look out for. What do you think?
Yeah, this sounds great to me because where this came from is, like you said, we were jamming out with advisors and we were digging through a tax return, and it was a redacted tax return. So there was a lot of information missing, but on one of the Schedule Cs, we could see that they had left in the name that it was an LLC, which that raises a question of we want to make sure it actually is an LLC and they didn't just type that.
Correct.
But then you
sorry, you got to pause right there. That is a 100% correct statement that you have to look into.
Yes, I'm completely serious, 100% serious on that. Just because you got typed into a software doesn't mean it's real. But this brought up quite a few questions. And one of the questions you posed that kind of got that deer in the headlights was, okay, great. Let's assume it is an LLC. How is it taxed? A lot of the room instantly gave responses of, well, it's a disregarded entity. It passes through, like all these different things. And there was one person who somewhat quietly said, it depends. Like ding, 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 ding.
Chicken dinner, we have a winner, right?
Yes. Yeah. It depends. And when we talk about business structures, when we talk about LLCs, a lot of people do want to talk about the taxes first. But that's not even the whole question, because we don't just set up business structures for tax purposes. We need to understand the tax impacts. There definitely are tax impacts, but that's not the whole reason we have them.
You know, and a lot of times when I get working with clients that want to start their own business, they want to rush out and do an LLC. Mm-hmm. Right. And I kind of equate this, and I say this a little bit more lovingly on the client side than I say it on the advisor side, but this is playing office, right? There's so many, they're like, oh man, let's get into a long, detailed business plan. Let's set up an LLC. Let's talk with the attorneys. Like, whoa. Before we go spend $10,000 on miscellaneous stuff, let's come up with a one-page business plan. You tell me what you're going to be. Let's look at actual revenues, and let's really have a conversation whether it's worth playing that office and going to the LLC. Not saying LLC is playing office, right? But it has its place in time. So even before we get to this conversation, before that, you got to have a conversation with your clients when they're going to start up an entity about saying, hey, is it even worth starting this up? Where are you at? What's your revenue at, et cetera? And then, Steven, I'd love your thoughts on it. So when I'm explaining it to a client, because you are correct. It depends on how the LLC is going to be taxed, is what elections that we make. Yeah. And they want to get into these S-Corp conversations and whatnot. And I'm like, hey, let's hit the brakes on this. This is a revenue question. Yeah. Right? The more money you make will dictate the entity we probably want to go into, but that's not by default the entity I'm going to choose for complexity reasons.
Yeah, I mean, I know I'm the tax guy here, but this is definitely a situation, like many situations, where taxes are an important consideration, but they're not the driver. We can't start, your entity determination should not start with what is the tax implication. Like you said, we want to talk about where it's going to grow to, what our expectations are. We want to talk about how the ownership structure is going to work, how many people are going to be involved, how do we want distributions to work, what happens if we have new partners or less partners. I mean, there's all of these considerations before we ever get to how do we want this taxed. And the internet's such a lovely place. There are certainly people out there who will tell you it's S-Corp all day and only S-Corp for every situation without exception. But even before we get to the tax piece, there's so many other considerations.
Yeah. So let's talk about some myths or misnomers that are out there that I kind of hear first. And then I'd love to get into maybe some client use language that I use. And I'd love your feedback on it. Yeah. On how I'm explaining LLCs, how we're structuring it with clients as well. And then kind of wrap up with the true tax piece. Give you guys, listeners, a reason to stick around to the end.
Perfect.
Does that sound good?
Yeah, I love it. Let's go.
All right. So we can go back and forth on kind of myths we heard about LLCs. This will be fun. And we didn't pregame this, so it'll be even better. Let's see. Myth number one about LLCs is I have it with a partner, but we're each going to file it on our own Schedule C to make it easy. True or false? Can you do that? correctly? Can you do it correctly? Not does the software allow it. Is that a correct way to do it?
Fine. Make your clarifications. Yeah, because the software will let you do it. No, that's not a correct way to do it. And we won't get off on this tangent, but I recently saw somebody report 50% ownership in rental properties on separate Schedule Es. That was a fun one too.
That's a fun one.
Yeah, but no, if we've got more than one person involved in an LLC, we can't just all report our separate Schedule Cs.
That is correct. It's not a magic thing inside of there. So by default, if there's more than one person on the Schedule C, you are a partnership. Is that right?
That would be correct. Yes. Yeah.
So by doing nothing, if you have more than one person. Now, how does that work if you're husband and wife?
Yeah. So, Micah, this is one of those areas where I love to hear how you're explaining this to people, because there are some nuances. We're getting into the legal side of this, and it depends on the state and how these things get set up.
Ding, ding, ding.
Yeah, because it'll be different in each state. Even though we're talking about, a lot of times we're talking about federal tax filings,
right.
Especially you and I. You're from Alaska, I'm from Washington State. We don't talk about state income taxes hardly ever. But we've still got to sort out that legal question. How does the state treat that husband and wife? Because that's going to affect whether they're immediately a partnership or we can just report it together on a Schedule C. So it depends on the state we're in.
Fair enough. Okay, another myth that I hear inside of this, if I set, this will be a tough one for you. Let me see how to phrase this really well. If we set up an LLC, I can or cannot transfer my rental property into an LLC without affecting my mortgage. I know that's not a tax question.
That's not a tax question. What do you mean by affecting your mortgage?
Due on sale clause. If you move a property into an LLC that has a mortgage, do you trigger the due on sale clause?
And so, Mike, if a client brought this up to me, I would say, hey, great news. I'm the tax guy.
Perfect.
And I'm going to help you get the answer, but that's not something I'm going to quote you off the top of my head.
Awesome. And the answer is, you probably know this, it depends.
Right? It always depends.
It depends,
for sure.
Right? It depends on the lender. It depends on how the LLC was set up. It depends on how you communicate that to said lender, right? So there's some rental properties. So I'm a huge fan of having rental properties inside of LLCs, but we can see it done wrong. That's there. So you got to be really careful about this as well. A lot of people will create LLCs, but they won't fund them.
Yeah.
Just like creating a trust, but you never fund it. You never put anything in it. You don't have any protection with that. All right. What other myths or misnomers that you see commonly about LLCs, Steven?
Well, you talk about putting rental properties in LLCs, which is great. And the reason we're doing that obviously isn't for tax purposes. We're doing that for liability protection. And so that there's another one that comes up where people don't really, even if they have their rental property inside of an LLC, they're not really thinking about their rental property as a separate business. So they're still doing everything out of their personal checking account. They're not actually treating it separate from themselves in a way that they're actually going to get that liability protection. Another one, that one of my favorite statements, questions, whatever you want to call it, that I hear from clients is anything to the effect of, well, my LLC will be taxed on that, or we'll deal with that with the LLC tax, or not understanding that, it's not the LLC that gets taxed.
Correct. That's the huge thing, right? The LLC is just a liability entity. That is it, right? It does not matter on the taxes whatsoever. That's a separate decision that we have to make. So when we're setting up business structure, the first thing is, what are we solving for? Before we reach into that toolbox and we take out all these cool things we can do, what are we trying to build? What are we trying to solve for? Then we start looking for those things in the toolbox.
Yeah, absolutely. And Micah, this makes me think of other conversations that you and I have had about setting expectations with clients so that we're having these conversations with them before they've made the decision.
Ooh, that's a great point.
Because we can do so much more to help them if they're coming to us before they've gone out and filed for their LLC or made all these decisions already. If we've set the expectation with them that we want to be involved in all of these conversations as early as possible, now we get to be proactive instead of reactive and having to go back and change or fix or unwind messes.
So this is one thing before you created retirement tax services, right? That was an issue that came up years ago with a client that I had to deal with. Is they went out and created a business, and they did an LLC, and they talked with their accountant, and they did an S election, and then they decided not to pay themselves, but then later just to claim that they paid themselves by not paying themselves. And Steven's laughing outside because he's got his hands over his head right now. He's like, oh crap, I know where this is going, right? Because they wanted to avoid the FICA tax on this whole thing, but they weren't doing payroll.
Yeah.
So here's another misnomer inside of it. Just because you have an LLC doesn't mean you get all the tax benefits of the different tax entities that's there. You're still limited by the tax entity is the wrong word, the tax preference in which you elected to file under. So by default, it might be a partnership if there's two of you. It might be a Schedule C, but it might be an S Corp. But just because you're an LLC, that doesn't mean your friend who has an LLC who does it differently means it has the same way that you're going to do it as an LLC, because we got to look at not only the entity, how it's set up, how are your bylaws set up, how is the state set up inside of there, but what tax election did you make? And we got to follow those rules.
Well, and that last point about we have to follow the rules is really important, because even if you make the S election, because that's what always gets the headlines on the internet, right? Is make an S election so you can avoid all the FICA taxes. Here's all these great things you can do.
Right.
But just checking the box, and it literally is a box, right? Here's what
easy.
I elect. I elect an S Corp. But to this client you're describing, if you elect an S Corp and then don't set up payroll, if you don't treat it like an S Corp, sure, the software is going to allow you to do that. But guess what? All sorts of small business things raise red flags for the IRS and are more likely to raise questions, especially when the IRS, I don't know, hires 80,000 people.
When is that going to happen? Moving on.
And so we actually have to run it as a business. We have to run it as an S Corp. We can't just... so many things in there. We can't just not pay ourselves for the whole year and then say, oh, wait, I'll just write myself a check and call it payroll. That's not how payroll works.
Right.
Yeah, we've got to run this like the business that we elected it to be.
Yeah, and I see that happen often, especially when someone goes from a Schedule C to an S election, right? Because they're used to doing it as a Schedule C, which is super easy. You just take money out of the bank account whenever you want, right? Because all of your income is subject to self-employment tax. And so it really doesn't matter. There's no payroll for you as the owner under, correct me if I'm wrong, under a Schedule C, but there's really not a payroll requirement for the owner to take money in and out or anything like that, is there?
No, when you're the sole owner of a Schedule C, some people might think of it as their payroll or their wages, but no, but we don't need to formally set up payroll.
You're not filing 940s or 941s or any of those things, right?
None of that stuff. Micah, there's something that you do with clients who want to set up a business like this that I just love, and hopefully I'm remembering this right. So correct me the pieces I'm getting wrong. But if you've got a business owner or somebody who's starting a business, they want to run payroll, they want to have an S Corp, you actually help them kind of. I role play this almost. That's probably not the right word, but you help them get the habits. Simulate. There we go. That's a much better word. You simulate this before they're actually doing it, so you're getting the habits in place.
Yes.
And I love that you do this because, and I want you to describe a little bit about how you do it, because this is where I love collaborating with advisors, because you just have access to do things that I can tell my clients about, but you can help them actually do it in practice.
Yeah. Is it okay? I want to answer that one first, but I'd love to back up a little bit and explain what I do right before that to help illustrate this to a client.
Please do.
Well, fantastic. All right. So what I do is the first thing I'm going to do is get a piece of paper, or if we're on Zoom, I have an iPad, and so I use a Jamboard. It's just a Google thing. I do a screen share on my Zoom, and then I can draw on my iPad, which makes it super easy for a whiteboard, right? When I'm trying to draw on my mouse and show something with a client, for me, just my handwriting's bad enough. My mouse writing is even worse. So I open up a Jamboard or on a piece of paper, and I draw really quickly what the client's assets are, because I want to describe what we're trying to protect. So this is going to be right and left side of the paper. So on one side of the piece of paper, I'm going to write down their bank account, their income, their house, their retirement accounts, like all of these assets, and I'm going to put them all on one side of the paper. Then on the other side of the piece of paper, I'm going to put the business or rental property, could be inside of here, and say, now here's what we have is you have this business, but the first thing we need to do is, just by having a business by itself, you have no liability protection. Okay, your IRAs have some protection, your house has some protection, but all of these other assets are subject to liability. If you get sued from a rental or a business activity, there's nothing that's protecting you. And then I want to explain how insurance works. Your insurance is there to pay a claim. Your LLC, limited liability company, and that's the same way I explain it to a client, because I want to break those words down for them. Your limited liability company is designed to limit your liability in a claim. Then the insurance pays it. So our job is to get this set up so that there's the least amount of legal claims someone can come after. Then what I do is I take it, if they have a rental property, I draw like a little stick house, or a business, I'm going to draw a box around it. And I said, what we're going to do first is we're going to put a moat around that asset, and that moat is called an LLC. And then I talk about where people get in trouble with LLCs. Right, is they don't treat them as a separate business. They treat them like a separate bank account, and they're hiring vendors, and I'm drawing back and forth on this. They're hiring vendors, they're paying from our personal account, they're taking money out whenever they want, they're doing all these naughty things. And when they do that, that makes the liability the LLC subject to be pierced, and all of a sudden you lose all of this protection. Well, if you're going to do this, then don't do the LLC, because why spend all of the money to set this up and go through the hassle with it, et cetera? So if you want to set this up first, number one, we got to understand how to set it up. So again, I redraw those boxes. I say, what you need to do is get a bank account, and I put this inside the LLC box, and get a credit card, and I put that inside the LLC box. All of your money outflows got to run through that. And then I draw back and forth a line between the client's bank account and the LLC bank account. Say, hey, you can move money back and forth here. This is going to be okay for a rental property. But anytime we're moving money outside, we got to follow these rules first. And the reason I'm drawing it this way first, Steven, this now gets back into your question, because when I draw it this way, now when I talk about I want them to simulate doing this, now they have a visual reason as to why this is important.
Micah, that's so genius to get so clear on the why. And people talk about that all the time. That's a catchy phrase of what's your why.
Right.
But there's a big difference between just asking someone, hey, what's your why? Like, good luck asking your client what's their why on an LLC and getting the kind of answer you just described. That's where we're there to help them and understand really clearly, here's why we're doing all this. So that when you get, like, to your point, when you get to that conversation of we're going to simulate this, if you haven't had that conversation first, well, what are we simulating? Why would we do that? Yeah.
Yeah. So I'm gonna draw that out. Then I'm gonna talk about saying this and saying, okay, let's say it's a business property, just for discussion, and say, all right, we got to be really careful on how we take money out of this for tax reasons. Now, I can get into the complexity of this, but I want to make this as simple as possible. A couple things we need to do. Number one, we got to make sure we know how much income you have coming in. Number two, we need to be careful in how we take that income out so you don't overpay the IRS. Mr. and Mrs. Client, is it okay if we go through this so you don't overpay the IRS? Right? And then you say, yes, of course, right? And this is a really true question because I want to make sure we're setting this up correctly. And now I've put some really important emphasis on here on them doing it. And then what I do is say, great, here's what we need to do. We need to do a separate bank account and set this up. Now we clear at Schwab, so I generally recommend they open it up there so I can see it. We set it up just as a bank account, that they open up into this bank account, and then they can put money into this account. Now, if they're going to move to like an S Corp or they're going to move something else, I'm going to do it a little bit different, et cetera, depending on what type of tax entity we talk about. But I want them to have an income account, which all income they get paid, whether that's rents to an LLC, whether that's business income, et cetera, all goes into this income account. If they have multiple businesses, guess what? It's multiple accounts, especially if it's multiple LLCs.
Absolutely.
Right? Now, you can do this crafty thing. If you have multiple LLCs, then you can have this management LLC, and you can do all this fun stuff, which creates a lot of work. But I want to create this as simple as I can. For every LLC, you have a separate bank account, you have a separate credit card, and we can easily track that income that comes in. Now, after we have that discussion, then we can have a discussion about how do we take money out.
Micah, I love how you're setting that up in so many different ways. I mean, selfishly, as a tax preparer, I love that you're setting that up because it's going to make taxes really easy at the end of the year because now we have this clear separation. We're not wading through everything that's going on. But again, even though I'm the tax guy, that's kind of a perk of it. We're making sure we're setting this up in a way that the client's actually getting the benefit from having gone through the trouble of filing for an LLC.
Right. And that's the huge part about it, right? Because so often they'll get the LLC set up, they'll use LegalZoom or whatever, which I'm not knocking, but that doesn't tell you, and maybe it does, but maybe just my clients don't understand it, however that's going to be set up, but it doesn't really explain to you what the importance of keeping on top of these things. The other thing we're going to go through, Steven, is we're going to go through and talk about what's the annual filing, what state to get in there, how every state is going to be different. I'm kind of biased in Alaska. We have some pretty good LLC laws and protection, how it's different in different states and how you need to set these things up. And if you as an advisor aren't equipped for that conversation, no worries, bring someone else in who is. If you're not equipped for the tax conversation, bring in a great COI, bring in RTS, right, Steven, and say, hey, we need to explain how this works to a client so we can make an informed decision in this. And Steven, I'd love your thought on this on the tax side. I normally tell clients, let's just make it simple. Let's just say it's one person on the LLC. Start as a Schedule C.
Yeah, Mike, I'm right there with you. We can go down a more complicated route as we move along, but yeah, let's start simple and then move from there. Let's not play office right out of the gate and see how complicated we can make this. Especially if you're asking from a tax perspective, hey, guess what? It flows through the same way, whether it's on a Schedule C or on a 1065, right? We're overcomplicating it for no reason, certainly on the tax side. But let's get the systems and processes set up correctly, build the habits, all those different things before we move on to other levels of complexity.
The other thing that I like to do too, and I love your thoughts on this, is if the client's really bent out and really wants that S Corp, right? I'm going to have a conversation with them about reasonable comp. How the heck do you figure that out? Now, I do totally blame that on the CPA. It's great. You and the CPA get to figure out reasonable comp. So how do you address that with a client when they decide what do they want to pay themselves? Well, for why don't you explain what is reasonable comp? What is that IRS definition-ish? And then how do we apply that?
Yeah, the kind of the idea behind reasonable comp is what would someone in a similar position who wasn't the owner get paid to fulfill that job function, right? And so it's always fascinating to me when a business owner wants to give themselves some really lofty title. That's like, okay, you're actually setting yourself up for, okay, well, what would a CEO of that type of company make? Anyways, that's kind of a side tangent.
So the title of you should always be the janitor? Is that what I'm hearing?
Yeah, fair point. There's the title you give yourself and the roles that you fulfill. So I like using the Department of Labor's labor statistics as kind of a benchmark. That's not a perfect number, but they've got a lot of great data about different types of roles and industries so that we at least have a benchmark. And this is certainly an area where I'm going to have a conversation with a client and help them kind of understand a range. That number isn't going to be a perfect answer, but it's something that we can go back to, because I like to set these things up in a way that if the IRS ever did come and ask questions, I would feel comfortable explaining our rationale. Even if ultimately the IRS says, I don't agree with you, I still want to go in feeling confident with where we started and what our documentation was. And so that's where I'm going to start as far as what reasonable comp is, because we're trying to get to what would someone in a similar position potentially be compensated. What the IRS is trying to get to is that since through an S Corp we can have owner distributions that aren't subject to FICA tax, we don't want this situation where we say reasonable comp is $1 and everything else is not subject to FICA tax.
So let's dive into that a little bit more. So let's say we take the labor statistics, whatever, and let's say the comp is 80 grand. I'm just making a number up, right? So whatever that position is. So let's say you divided that out by 2080, right? There's 2,080 work hours in the year. So whatever that hourly rate is, I don't know. So you get that hourly rate. Would it be reasonable for an advisor to go out and say, and if I'm going to get you in trouble, you can just not answer this. Would it be reasonable for an advisor to go say, hey, great, I don't work 2,000 hours in a year. I work 1,000 hours in a year. So my salary shouldn't be 80 grand. It should be 40 grand because I can document the hours that I'm working.
So Micah, have you ever had the IRS ask one of your clients about that?
Yes.
And how'd that go?
Really well.
Yeah.
Yeah. We had documentation.
Yeah.
That's
what I was getting at. That's what I was getting at, Micah, is that when you have that conversation with the IRS, and it can't be documentation you made up on the spot.
Nope.
Yeah, when you do this stuff, document your, this is what I go through with clients. And there are times where I will sign off, for lack of a different word, on a more aggressive end of the spectrum if we can clearly document our argument.
Yep.
If the client just says, well, I want it to be 20 grand, okay, that doesn't work.
Why? Right? Yeah.
And so that's a good example of here's our logic, here's how we came up with it, and we've documented it, we've laid it out, and the IRS could come in, and I would feel confident explaining that to the IRS, and if they disagree with us, okay, great, we're going to owe some additional taxes.
Right.
Well, maybe not great, but we're going to owe some additional taxes.
Here's the risk.
But yeah, I'm going to explain that to the client as well. And so we're all going to go in knowing that here's the risk, here's the possible outcomes, but we're going to feel confident in how we set that up. Yeah.
So in this particular case, this was an engineer, and he was scaling down his practice, but he was getting paid a lot as a retainer, but he wasn't working for the whole thing, but the company was like, no, we're going to pay you as a retainer to keep his business on there. And it was a long conversation back and forth with the CPA going through it. And I was like, look, if he's documenting his hours, why don't we go out there? We look at the Department of Labor Statistics. Why don't we go out to the engineering boards and designations out there and say, great, what's average comp? And why don't we just pay him as an hourly employee? Yeah. Now, we had him sign an hourly employee agreement with his company, right? Because you got to keep in mind, depending on how you set this up, you wear two hats. You wear an employee hat and an employer hat. In my opinion, and I could totally be wrong, so feel free to push back on this, Steven, that if you're going to put on your employee hat, then you need to be signing the same things your employees would sign, even if it's employee of one. So you should have an employment agreement. So we had an employment agreement set up for this client, and it says he's going to track his hours. This is how it's going to do it. We had an hours tracked in his software, and then we ran payroll versus his CPA ran payroll for him based on his hours worked, and all of that was tracked every single month. And so when the IRS came back as a routine audit, they definitely flagged it because he had a pretty high K1 compared to his income. Yeah, and that was definitely a hot pot item, and we just laid it all out for him. Yep, and they were like, okay. Yeah. Next.
Because what's their argument going to be at that point? And it's really important that you're making this distinction, or that you're going into this detail of all the things you had in place, because this is an area where there are flashy headlines, and then there's what works in practice.
Yes.
Because the software will let you put in $20,000, $10,000, $1 as your compensation, great. The software will let you do that, and then you'll get a huge audit red flag. And if you get picked, you're going to have a really hard time explaining to the IRS, and you're going to have a really hard time proving that after the fact. You have to set these things up at the outset, not when it becomes an issue.
Steven, I think another thing on the LLCs as well that's going to come into effect is, let's say you do this S election, because that's kind of what we're talking about, right? Because what we just talked about, if you're doing a partnership, doesn't matter at all. So this was just an S election. But the other downside of an S election is it's going to dramatically limit how much money you can put in a retirement account, because your earned income is that W-2. Your K-1 on an S corporation, correct me if I'm wrong here, but your K-1 is not earned income. You can't use that money in a retirement account, correct? Like a 401k.
Yeah, I think I got a little turnaround in how you laid that out. But yeah, you're exactly right. It changes the numbers on what we can potentially get into a retirement account. Because again, flashy headlines, sometimes they'll tell you, oh, solo 401k, SEP, LLC versus S Corp election, or partnership versus S Corp. It's all the same. The top limits are all the same. Well, yeah, the top limits are the same, but the math on how we get there is very, very different.
Yeah, so we had a doctor that the CPA was being pretty aggressive. She went to jail for a different reason, but it was an embezzlement issue. Luckily, not with our client. But she was very aggressive in pushing the income down for the client, and we had to have a long conversation back and forth with her. We're just saying, hey, look, you're the call on this one. I don't think this is reasonable comp, but that's not my stick, right? That's between you and the CPA, and she's signing off on everything. But here's the main issue with it is this dramatically limits how much you can put in a retirement account. So we got to weigh these things out. So yeah, you got to pay self-employment tax on it. There's your downside. And I still consider it W-2 income as self-employment tax. I know technically it's different, but it's not. And so you still got to pay that self-employment tax, but you're really limiting. And he had himself and his wife on his S Corp. I said, hey, if we paid both you guys a decent salary, we could stick a crap load of money away in retirement accounts for you. And so you got to weigh these things out with that self-employment tax.
Yeah, absolutely. How much you pay in payroll taxes also affects how much you're going to get in Social Security someday.
Yeah.
Which is a disconnect in expectations. Maybe that's still the right decision, but it's a big disconnect in expectations if people aren't drawing that connection.
Ooh, let's get political. If you could opt out of Social Security today, would you?
Micah, great news. Everybody I work with, when I work with them individually, they always want to personally pay less in taxes. And then aside from that, I don't get into politics.
Oh, so good. All right. So this is really, really important. The other nuance that I'm going to put out here as well is that if you're doing any help with businesses or a solid value add, is most states, not all of them, but most states you can pull up online and see if the LLC is active. Right? Because so often LLCs will be filed because the IRS does not care if you, correct me if I'm wrong, I don't think the IRS cares if you have a business license, right? That's not a check.
No. The IRS cares if you're getting money from people that they can call income.
Yes.
Yeah.
Yeah, but the IRS doesn't care about that stuff.
Not the IRS.
There's a huge disconnect between those two. And so it's another solid value add I think advisors can play is do a quick check and to see if the LLC is still current, right? Did they pay for a business license? Because you don't have a business, and again, I'm not an attorney on this stuff, but state of Alaska, if you don't have a business license, it doesn't matter if you paid your LLC fee, it's not a valid LLC, right? So you got to bribe the state. Well, I guess it's not technically a bribe because that would be illegal. You got to pay their fees, whatever you want to call that, for the LLC as well as for your business license in order to be valid. And so this is a solid area that I'm going to say CPAs won't look for. I'm not digging on CPAs, but correct me if I'm wrong, CPAs don't check for that, do they?
No. And what's great, Mike, about what you're describing is that this fits right in line with so many things that you talk about at the Perfect RIA, because this is a value add that you can delegate to your team. The advisor doesn't have to be the one looking this stuff up.
Yeah, that's such a great thing that you get to pull up. You get to look at all these things. It's a good tickler you can send out to your clients, a good how-to to file for these things, right? Like RTS did a phenomenal job putting together, we send out to our clients, a how to make quarterly tax payment guides, right? If you're working with small business clients, then maybe you should do a quick little how-to, keep your LLC current. What are the key dates you need to be looking at? How do you pay the taxes? How do you pay it? How do you make sure it's there? We didn't even get into this, but what documentation do you need to keep as good record keeping for these things? It's not that onerous if you take it a little bit at a time. But if you don't do these things, you can create one heck of an issue that never gets caught until you're in a lawsuit.
Yeah, and that's the wrong time to be thinking about documentation.
Yeah, sorry, Steven. I know we took a little bit more of a legal tint than a tax tint, right? But it's all of these things are connected.
No, that's perfect, Micah. And there probably are people listening thinking, wait, why is the tax guy on here talking about it? But the reason I'm on here talking about it, push back on me if I'm wrong, is because the question more often comes up because of taxes, but these are all the things that really need to go into it.
Yeah, they are. There's a lot of stuff that goes into this. So especially if you have clients that are doing the TurboTax thing, filing their own business returns, man, that is a red flag for me because they're just done wrong in so many ways. But these are definitely things that are value adds that are in your control as the advisor that you can do. So this podcast is all about action items, as you know, Steven. And as you're the guest, I'm going to let you go first. So what is the first action item for our listeners?
Yeah, well, so the first action item is that you need to make sure you have every tax return for every single client every single year.
That's a good one.
But to go along with that, Micah, I love this value add you're describing. What a great thing you can delegate to your team that is going to add massive value to your business owner clients to go and look up and make sure their businesses have been filed, that they're active. Great way to apply the dishwasher rule if everything's in order, to go ahead and let them know, hey, we're looking out for you. Here's what we checked on. Here's what's going on. And then here's some documentation things to keep in mind. So that's a solid one-page value add right there.
I love it. Number 2 action item I would do if you do any work with small business clients, you need to get good at presenting how an LLC works. Now, I always throw the disclosure, I am not an attorney. This isn't legal advice. This is my interpretation from a financial planner of how you should set things up. And when we bring the attorney in, they can either bless this or say I'm incompetent, and we'll figure it out from there. But you need to get good at explaining how does an LLC work and what are the 1, 2, 3 steps a client needs to do. And it's not figuring out your tax entity at first.
Yeah, and to get good at anything, you need to practice this and not in front of clients. You and I have talked about that in the past. I know you bring it up all the time, so we won't dive deep on that right now. But you have to practice this before you say it to a client.
I love it. All right, this podcast is all about action items. Make sure you go and do that. Steven, great shout out to you. I have thoroughly enjoyed working with RTS. My team actually has enjoyed it. That was the big concern that I had when we're moving our team over. Steven's like, what the hell are you going to say? I don't know. But that was a big concern that I had is when we started using RTS a lot, is saying, you know what, how is this going to work for my team?
Yeah.
Because if my team came back and said, holy crap, this is a bunch of work on us, that could easily kind of blow it up. And it was 100% the exact opposite. They were like, hey, we really enjoy this. These are some solid things that were there. There's a couple things where it was like, hey, we'd really like to see this. And the team was able to bring up to RTS, and RTS was like, you know what, that's a solid idea. We should totally do that. So I really appreciate you guys working with my team to help deliver more value. So thank you for all that great work you guys do.
Yeah, of course. Love to hear that it's going so well on your side as well, because it's a great experience for us too.
Awesome. Well, until next time, happy planning.
Happy planning.
Hold on before we go. Something that you need to know. This isn't tax, legal, or investment advice. That isn't our intent. Information designed to change lives. Financial planning can make you thrive. Start today, don't think twice. Be a better husband, father, mother, and wife. The perfect RIA, the perfect